So the important thing about learning objective 3, which talks about dividends mostly, is to sort of understand that the most common type of dividend that's distributed is a cash dividend. And so there's heavy emphasis on the cash dividend in this learning objective. However, there are other types of dividends that are provided to stockholders on occasion. There are some that give property dividends. There are some that instead of paying a cash dividend will give additional shares of stock to shareholders. So that's called a stock dividend. So we'll be looking at focusing on cash dividends first and foremost. That's the big part of the chapter. But we'll also be going over a stock dividend, what that looks like from an accounting perspective, and the difference between a stock dividend and something you've probably heard about, a stock split. So we'll be looking at all of those today. Okay. So in terms of, remember, a dividend is a distribution to stockholders, normally in the form of cash. That's the most common. Dividends are expressed either as a specific dollar amount per share, which is normally what we hear about in the news and so forth. But dividends can also be expressed as a percentage of par value of a stock, which is actually common for preferred stock, as you'll see. So let's start our dividends. Again, heavy emphasis on the most common, which is the cash dividend. Literally the company paying out, giving out checks, giving out cash to owners. So corporations, and 80%, by the way, 80% of the corporations in the S&P 500 index do provide their stockholders with a cash dividend. It varies quite a bit. But before a corporation can actually pay a dividend to its owners, they actually have to have a profit. So they have to have retained earnings. Why? Because most states require it as part of the law. That in order for a corporation to share a dividend or to give a dividend to the owners, to the stockholders, they have to have profits on the books to share. So that's the first thing. Another thing that they have to have is they have to make sure they have enough cash to write all those checks, right? Because ultimately that's what a cash dividend is, sending out of cash to the owners. However, the only group of folks in the entire corporate structure who can decide whether dividends are going to happen are the board of directors. Okay, the board of directors have to declare that a dividend is going to be paid. They're the only entity within the corporation that can do that. The stockholders can't decide, they want it. Management can't decide, it has to be the board of directors. Okay. So again, in order for to understand cash dividends, we have to understand the process. And so this gives you the idea of what the process is. Everything starts with the board declaring that they're going to pay a dividend. Okay. So here in this scenario, on the 1st of December, they declare, the board of directors declares a cash dividend is going to be paid. Okay. So that is called the declaration date. You need to know that. So declaring a dividend is going to be paid is one thing. Who is going to get the dividend? Who is going to get that cash is another. That question is answered on something called a record date. Okay, so notice the second date on these calendars is December 22nd here. And the record date basically is a list of all of the shareholders who own the stock as of that day. So how records date work, again, the stock market's open, 5 days a week, right? Except holidays. And what's happening is um, there are shares of ownership being traded back and forth, right? Some people are selling shares, some people are buying shares. Well, at the end, all of those transactions, by the way, are recorded. Okay, so we know who owns shares. Brokerage firms back in the day used to keep track of all of that. Now there are specialty organizations called transfer agents. Some custodial banks do it as well, but they keep the records of who owns the shares of stock at the end of a particular day of trading. So the corporation calls the transfer agent or the custodial bank in some cases to say, okay, at the end of the trading day on the 22nd of December in this example, I need you to send me a list of all of the shareholders and how many shares they own. Okay, that's the only thing that happens as a record date. They simply print out a very large document, all the owners and their addresses, how many shares they own, and they send it to the corporation. That's it. It's the only thing that happens there. As you see, it takes a while for the corporation to process all of that. So the last date that's important is when the corporation actually pays those dividends. They are paying the dividends to the people who are on record as of the record date. Those are the folks who are going to get that dividend that was declared earlier on. Okay. So here in January, on the 20th of January, that's when all these checks are going to get cut and sent to the owners. Okay. The owners that are on this record as of that date. So that's the process that happens when a cash dividend is declared by corporations. And because dividends are declared every 3 months, every quarter, this happens all the time. So it's important to know. So what's the accounting like? Well, the accounting has to happen as well. So let's go over how that all works with an illustration. On December the 1st, the directors of Media General declare a 50-cent per share cash dividend on 100,000 shares of their common stock. Okay. The dividend is not payable until the 20th of January. And the shareholders at the end of the trading day on December 22nd are the ones who are going to get the check. They're the ones who are going to get the dividend. Well, first thing is when the board of directors declares they have a dividend, they're going to pay a dividend. What they've done is they created a liability for the corporation. Now the corporation owes these owners a dividend. So the accounting record has to show that. First thing, they debit the dividends account for $50,000. In this case, it's 50 cents a share times 100,000 shares. That's your $50,000. And they set up the liability called dividends payable because it's a liability because they promised payment on December 1st. That's the promise happened on December the 1st. They're not paying it until January 20th, but they promised it here. So that's why it has to go down. So they debit the dividends account, credit the payable account. Now, as you also know, who they send it on, who they're going to send that to, that list comes on the 22nd of December. Well, it's just a list. There's no entry. It's just a list that's given to the corporation. Here, these are all your owners, and this is how many shares they own. It's simply a list of people and the number of shares that they have. That way, the corporation can start setting up payment to those people that are on the list. So there's no entry, there's no accounting to do as of the record date. But when it's paid, there's more accounting to do. So January 20th is the payment date, which means they're going to be cutting those checks. So basically that dividends payable becomes paid on the 20th. So we debit the payable account and we're going to be crediting the cash account because it's a cash dividend. So we're sending all that out in cash. So 3 important dates to know, right? The declaration date, the record date, the payment date. But in accounting, we are only really doing entries on the declaration date because that creates a liability for the company. The company just declared, hey, we're going to pay you a dividend, so now we owe you this. Right? And of course, when they actually pay it, right, there's going to be an entry. So those 2 things are important to remember. So a review here is when are entries going to be required for cash dividends? Well, they're going to be required, as you know, on the day the board of directors declares it, right? And the day they actually pay it. So the correct answer here is going to be D. The declaration date, we're going to be required to do a journal entry, and then on the payment date. There's no entry on the record date because it's simply a list of people and how many shares that are given, that are owned. That list is given to the company. That's it. There's no accounting to be done there. Fabulous. Well, here's where it gets a little bit more interesting with cash dividends because preferred stockholders, remember them, preferred stockholders have a right to receive dividends before common stockholders do. Right. So when a corporation is going to declare a cash dividend, the preferred stockholders are the first ones to receive it, and then the common stockholders will receive it after them. So this is specific to preferred. Now, preferred stock is often the dividend is often stated as a percentage of par value. So they will have 6% $100 par value preferred stock. So that means 6% of every 100 is going to be the dividend. They'll sort of list it that way, and you'll see an example very soon. In many instances, preferred stockholders have a right to receive dividends when the company is paying them. But on occasion, preferred stockholders have something called cumulative preferred stock, which means that the company then owes stockholders the dividend, whether they actually have the money to pay it or not. So the cumulative dividend basically means, look, if we don't pay you this quarter, we owe you that, okay, the next quarter. And so a cumulative dividend happens only to preferred stockholders who have cumulative preferred stock. It's a feature of preferred stock that a lot of preferred stockholders like. They're going to get a dividend, and if the company can't pay the dividend, they owe it to them. Cumulative. Of course, there is a lot of preferred stock that is non-cumulative, which means if the company doesn't have cash to pay a dividend that quarter, they don't owe anybody anything next time. So a cumulative is the feature that creates this. Well, what a cumulative dividend, cumulative preferred stock creates in the case that a company owes their previous dividend, it creates a liability called dividends in arrears. Okay. That means that they owe, in arrears is sort of a past, right? Or they're behind. No pun intended there, in arrears. But they're behind on their dividends. Right? So they owe that dividend before they can pay a new one, simply. So again, that creates a liability for the company that has a cumulative preferred stock. Okay. Of course, dividend preferences, preferred stockholders, they again get dividends first. If the corporations fail, of course, after the creditors get their share, preferred stockholders will get any leftover asset value in the case of that. But that's, again, less important than these first few notes here, which are very, very important. So let's take a look at this cumulative preference. Okay. For an example for this company, Scientific Leasing. So they have 5,000 shares of 7% $100 par value cumulative preferred stock. That's quite a mouthful, but that would be literally the name of the preferred stock. 7% $100 par value cumulative preferred stock. Okay, that's a real name of preferred stock for some companies. Which means the 7% of the $100 really is the dividend that's promised. That's the promise. So for each $100 share pays a $7 dividend, 7% of 100, $7 dividend. So because they have 5,000 shares of this stock, the annual dividend really is 35,000 promised to these 5,000 shareholders. Okay. Well, what happens then if the dividends are in arrears by 2 years? Well, this is a cumulative preferred stock, so they owe that dividend from the previous 2 years. That's the cumulative part. Okay. So 2 years in arrears means that the $35,000 annual dividend was missed 2 years in a row. So the dividends in arrears for the past 2 years was 70,000. Plus they want to pay this year, which is the 35,000. So the total amount of money going to preferred dividends would be the total of each, 105. The 2 years that they owed in arrears plus the current year. Okay. And here's a review question. You bet. Yeah, you bet. You betcha. They have 10,000 shares of 8% $100 par cumulative preferred stock. I remember that. No dividends were declared in 2015 or 2016. Okay. And now we're at the end of 2017. Okay. However, UBET has some money. They want to pay $375,000 worth of dividends in 2017. Well, again, the question asks, what are common stockholders going to get? Well, that comes after the fact that they have to pay the preferred stockholders, right? 8% on a $100 par value means $8 per share. They have 10,000 shares. So that means $80,000 per year is owed. They owe for 2015, they owe for 2016, and they owe for 2017. So $80,000 times 3 years is what preferred stockholders would get paid first. What's left over goes to the common stockholders. And what's left over would be $135,000. 375 minus 3 years of the dividends. Preferred dividends would be, right, $8 times 100, 10,000 shares is 80,000 per year. 80,000 times 3 is 240. So subtract out the 240 from the 375. What's left over can go to common stockholders. So step by step, this is how it's done. And here's a do it exercise, just what you wanted. Right? And it is on these preferred stock dividends, which are, believe it or not, reasonably important to know about. Okay. Okay. So what we have here is Mastermind, which is not related to Megamind. May I mind you? They have 2,000 shares of 6%, $100 par value preferred stock. Now notice you don't see the word cumulative. That's important because this is a non-cumulative preferred stock. That's good. In other words, if you miss a dividend, you don't owe it. If it's cumulative and you miss, you owe it. So that's how many shares of this preferred stock they have at the end of December 2017. The company has declared a $60,000 cash dividend, and they want to know how much of this is going to be paid to preferred stockholders and how much is going to common stockholders. Okay. Well, preferred stockholders get paid first. How much are they going to get paid? Well, first of all, they're going to get $6 per share. 6% of $100 is $6 per share, and they have 2,000 shares, right? So the first $12,000 of that dividend has to go to preferred stockholders. The first 12,000 has to go to preferred stockholders because they get paid first. What's left over is the 48,000, and that can all go to common stockholders. And that's how the $60,000 of dividends are going to be split with this company. Again, the preferred stock is not cumulative because it would be in the title. You would see the word cumulative here if it were cumulative, but you don't see it, so it's not. So part 2 here is they want to know what would happen if the company did not pay a dividend in each of the previous 2 years. Nothing would change. Okay. Why? Because the preferred stock is non-cumulative. You do not see the word cumulative in the title of the preferred stock. So thus it's not cumulative. If it's not cumulative, they don't owe for any missed dividends in the past. They don't owe them. Only if it's cumulative do they owe past dividends. So in this case, absolutely nothing would change. The solution would be the same. The first $12,000 would go to preferred stockholders. The remaining would go to the common stockholders. Again, preferred stockholders are paid dividends first. Common stockholders are paid dividends after that. So the third part here is what if it were cumulative? Okay, well, now it's different. Okay, of course, what you would see here is the word cumulative would be here. 6%, $100 par value, cumulative preferred stock. That would be the title of it. So if that's the title, then the preferred stock is cumulative, which means they would owe any dividends they missed in the past. And preferred stockholders have to get paid first. And here they tell you the company did not pay the dividend for 2 previous years. Wow. So they owe 2 previous years plus this year. So again, they owe 3 years of the dividend. Okay, we all know that this is the same dividend, 12,000, that was calculated in the early piece. 6% of $100 par is $6 times 2,000 shares, $12,000. But now you got 3 years to pay. A number of years to pay. 3 years at 12,000 means the first $36,000 of any dividend has to go to the preferred stockholders, because now they owe the preferred stockholders dividends first, plus the ones they didn't pay them before because it's cumulative. That's the difference. That means common stockholders would get the remaining amount, which would only be a paltry 24 grand. So it's a matter of putting those things in the order they're supposed to be. Next thing, a little less important, cash dividends are really the crux here. That's what you got to really know. That's where most of the questions are going to be. But stock dividends are reality as well. They don't happen a lot, but they happen. And what a stock dividend is instead of giving the stockholders cash, they give stockholders some more shares of stock. That's a stock dividend. That's it. And so, that's basically, stock dividends are similar to stock splits. They're not exact, but they're similar. And so what this little graphic shows here is, notice that the total amount of equity in the company is the same. That this block represents the total amount of stockholders' equity. The block is the same, just the number of shares are different. Okay, and that's basically, that's basically what we're going to be looking at here. So a stock dividend basically is a distribution of the company's stock. There's additional shares of stock that are going to be given to the owners of stock already in the company. What happens there, however, they have to pay it by decreasing retained earnings. Going to pay it somehow. Okay, they're not taking cash out of the company. That's a good thing. But they are, in essence, taking away retained earnings in exchange for more stock. So we have less retained earnings, but more capital stock. So you'll see that is going to be different with the stock dividend. Why do corporations actually pay a stock dividend rather than a cash dividend? Well, if they give you a stock dividend, they're not spending cash. And cash is important. You all know that. You need cash to do everything. So sometimes you don't want to give out your cash because you don't have a lot of it, but you want to pay the stockholder something. You want to reward them with something. And so the dividend can be, in this case, more shares of stock. That's a stock dividend. Companies that actually pay in stock actually are relatively attractive to other people because they know they're going to get more shares of ownership if they buy the stock. So it increases the marketability of the company's stock. And that basically is a plus. The first answer is the best answer, the most common answer, but certainly number 2 is a plus. And again, simply they are the portion of stockholders' equity shifts from retained earnings to capital stock. So it just, that's how they reinvest. They're reinvesting their retained earnings by giving more shares of capital stock. You'll see that. So stock dividends do something different. The composition of stockholders' equity is going to change. Total stockholders' equity does not change. That remains the exact same. What you're going to see change is retained earnings is going to decrease, and the amount of shares of common stock and paid in capital is going to increase. Okay, so you'll see an increase in those shares. That's it. That's what you'll see. So here's an illustration on how a stock dividend works. And again, I emphasize this piece a little bit less. You'll have a couple of problems, but I don't go hog wild on this. There's a lot to do on the cash dividend side, that's for sure. But again, you'll get a couple of these. So here is an example, and let's pay attention to how this works. Medlin Corporation declares a 10% stock dividend. So that's usually how stock dividends are declared as a percentage. So if you have 100 shares and it's a 10% stock dividend, you get 10% more. So they're going to send you another 10 shares on your 100. If you have 10 shares and you have 10, you get one more share. Right? So that's basically how they do it. So this is a 10% stock dividend, and it's going to be paid on its $10 par value common stock. Now, 50,000 shares are currently outstanding, and the current market price of those shares is $15 a share. So as you see in the first column, before this happened, they had, and only look at this column here, they had $500,000 worth of common stock. Okay, that's the $10 par at 50,000 shares. There was no excess, paid in capital in excess. They had 300,000 of retained earnings. That was their structure. 500,000 in stock, 300,000 in retained earnings. 800,000 total in stockholders' equity. They had 50,000 shares outstanding, which they talked about here, and the par value is 10, which is listed here. After the 10% dividend is paid, now 10% on the shares are at a higher price than the $10 par value. The current market price is $15. So if you issue 10% stock dividend, you've issued 5,000 shares more. You need 5,000 more shares. That's 10% more than the 50,000. And those 5,000 shares are at a $15 market price. So you know how this works from the last objective. The first $10 of the market price is the par value. So you have 50,000 because you got 5,000 more shares. 50,000 is going to be at the par. The other 25,000 is paid in capital in excess of par, because 5,000 times the $15 is your $75,000. Okay, that's the additional stock outstanding that you're putting in there. How do you pay for the $75,000, which ends up being the dividend? 5,000 shares, that's the dividend at $15. You pay for it by reducing your retained earnings. So you have more paid in capital. That plus 75 means you have more paid in capital, but you have less retained earnings. You have 5,000 more shares now as well. That's the 10% dividend. 10% of 50,000 is 5,000 more shares. At $15, that's your $75,000 difference. So then after your dividend, your stockholders' equity looks a little bit different. Your paid in capital for common stock is now based on 55,000 shares, not 50,000. Those shares are still at $10 par value, so that's where the 550,000 comes from. The 55,000 shares at $10 par. You have 25,000 in paid in capital of excess of par. That was because you issued a stock dividend at a higher price than the par. And then look, your retained earnings is now 225,000, 75,000 less than it was before the dividend, because that's how you paid for the dividend. You took it out of retained earnings and put it into paid in capital. You still have $800,000 in stockholders' equity. No changes there. So that's basically how to read this once a corporation issues a stock dividend. Okay, and that's a good little thing to look at. A stock split is similar. because the stock split does not change stockholders' equity, but it does change two things. Okay. It changes the number of shares that are available, and it changes the par value of those shares. Okay. So in a stock split, it works different. It works different. So let's take a look at that. So let's assume here that instead of issuing a stock dividend, the company issued a stock split, 2-for-1 stock split, which means if you're a stockholder, for every one share you have now, after the split, you'll have two. So if I had 100 shares before the split, after the split, I'll have 200 shares. That's always a good thing, right? More shares. Well, more shares doesn't mean more equity. Because as you see here, the stockholders' equity before and after the split is equal. As a matter of fact, nothing else changes. The actual the actual value of the common stock stays the same as well. As you see, no change in retained earnings. What changes? Two things. This company had 50,000 shares of common stock outstanding before the split. After the split, again, it's 2-for-1, they have to double those. So now they have 100,000 shares of stock rather than 50,000 shares of stock. But you cannot change the total value. So your par value is cut in half. That $10 share, this $10 par becomes $5 because 50,000 at 10 is 500,000. 100,000 at 5 is 500,000. You cannot change the total amount of common stock you have in terms of value on the books. But you can change those things, the number of shares and the par value. And that's all that a stock split does from an accounting perspective. It changes the outstanding shares and it changes the par value. But again, the numbers for the amount of common stock and the amount of total equity stays the same. Okay. And there's a little bit of some differences there that we just looked at. And so we're going to end learning objective 3 with a look at this, stock dividends versus stock splits. Okay. So here we have the market price of Sing CD Corporation, 500,000 shares at $2 par value common stock. The current price is $45. That's the market price, $45. The president of the company is considering both, either a 10% stock dividend or a 2-for-1 stock split. Your job is to show President Joan Elbert, show her the before and after effects of each option when it comes to retained earnings, total stockholder equity, and the par value. So the beginning balance is the company has 500,000 shares originally, right? $2 par value. Their original balances for paid in capital is $2 million. Their retained earnings is $10 million. Total stockholders' equity is $12 million. They have 500,000 shares outstanding at a $2 par value. Okay. If they did the dividend, right, the dividend would be a 10% stock dividend. Right? which means they would have to issue 10% more shares. So that would be another 50,000 shares would need to be issued. Right. Those 50,000 shares would cost money. There's no doubt about it, 45 bucks each, right? How do they pay for that? They reduce the retained earnings. Look at the difference. The retained earnings are reduced, and that amount is shifted up to paid-in capital. The total stockholders' equity has not changed, but we have 10% more shares of stock. That's it. Par value doesn't change either. However, if they did a stock split, absolutely nothing would change in terms of the paid-in capital or total stockholders' equity. Nothing would change. What would change is the amount of shares outstanding would double. So they would have an original amount of 500,000 shares. That would double to 1,000,000 shares. And the other thing that would happen is the par value would have to be cut in half. So a $2 par value would become a $1 par value under a stock split. Okay. And I'm sure you're all fascinated by now. A lot going on there. How'd you feel? Any questions?